Hi everyone, today we'll be going over accounts, October-November 2021, paper 2-3, question number 4. This is structured paper 2, which consists question of 90 marks and it also has a time limit of 90 minutes. And since question number 4 is of 30 marks, we will be attempting to solve this question under 30 minutes. So without any further delay, let's get started. EMM is a manufacturing business producing one product, a wooden desk. Then the business is contracted to supply 220 desks each week. So this is the weekly number of products to HCO, a large retailer, at a selling price of 44 per unit. Okay, then the costs incurred by EMM are as follows. We are given the direct material, production labor, finishing labor, machine hire rate, administration costs, and rent and rates. Now for the first question, we need to calculate the weekly break-even point in units. So the break-even point in units is the fixed costs divided by the contribution per unit. Okay, let's just figure out the fixed cost first. So from the given list of information, we can see that the costs are either per unit or per week. So whenever the costs are per unit, it means that it is a variable cost varying with each unit produced, right? And if you're given the cost as per week, it means that this is fixed for the week no matter how many products are produced. So these are the fixed costs. So if we're talking about fixed cost, then that's going to be first one we have right here, so that's 410 for production labor salaries. Then we have per week right here, which relates to finishing labor salaries, and that's 180. Then we have the machine hire cost, which is 120 per week. Then we have the administration cost, which is 400 per week. Then finally we have the rent and rates, which is 240 per week. So these are the fixed costs. So the total is just going to be 410 plus 180 plus 120 plus 400 plus 240, which is 1350. So this is our fixed cost. We then need to figure out the contribution per unit, and in order to do so, we must require the variable cost. So let's figure out the variable cost first. Like I said before, the cost relating to per unit are the variable costs. So in this case, that's direct material of 36. Then we have a production labor bonus of 0.50, and we have the finishing labor bonus of 0.30. So this gives the total variable cost to be 36.80. Now contribution per unit is just the difference between the selling price per unit and the variable cost per unit. So for this case, the contribution is going to be 44, which is the sales price minus the variable cost of 36.80, which gives the contribution per unit to be 7.20. So let's divide the fixed cost with 7.20, and this gives the break-even point in units to be 187.5. And since we're talking about units, we need to round it off. So we can round it off to 188. So that's the break-even point in units. This concludes the first part. Let's move to the second one. We need to define the term margin of safety. So margin of safety is just the difference between the break-even point and the forecast sales. Let's write it down. So margin of safety is the difference between the break-even point and forecast or budgeted sales. Now for the second part, we need to explain the usefulness of the margin of safety to a business. So we know that break-even point is that point where the business does not make any profit, but it also does not bear any losses. So basically, margin of safety is a measure of risk that allows a business to see how far the sales could fall before making a loss, because the number of sales made below the break-even points will result in the business bearing a loss. Let's write it down. So margin of safety is a basic measure of risk that allows a business to see how far sales could fall before making a loss. Alright, this concludes the second part. Now we can move to the third one. We need to prepare a weekly profit statement using marginal cost principles. So we will start with the revenue. Then we will subtract our cost of sales, which in this case is going to be the variable costs. Then we get the contribution per week or weekly contribution. Let's write it down as weekly contribution. Then we need to subtract the fixed costs. Then we will get our weekly profit. Okay, let's have a look at the above information. Since we are making a weekly profit statement, we need to consider the weekly number of units produced, which is 220, and each unit is sold at the selling price of 44. So let's figure out our total revenue using the unitary method. So if one unit costs 44, then 220 units will cost 220 times 44, which gives our total revenue to be 9,680. Now let's look for our variable cost per unit. So we figured that out right here. So variable cost per unit is just 36.80. But in our weekly statement, we need to record the variable cost of the total outputs produced, which is 220. So the cost of sales or the variable cost is just going to be 220 times 36.8. This gives the total weekly cost of sales to be 8,096. And we need to deduct this amount from the revenue in order to figure out our weekly contribution. So that's just going to be 9,680 minus 8,096, which gives the weekly contribution to be 1,584. Now we need to subtract our weekly fixed costs. Let's have a look in the above information. So we figured out the fixed cost per unit to be 1,350. So this is the amount we need to substitute in our profit statement. So that's 1,350, and we need to deduct this amount from our weekly contribution in order to figure out the weekly profit. So that's just going to be 1,584 minus 1,350, which gives the weekly profit to be 234. So this concludes the third part. Now we can move to the fourth one. Alright, we're given additional information. So EMM is concerned about future prospects, and it has spare direct labor capacity, and the machinery is not being fully utilized. EMM has been approached by K Limited, a large furniture company, requesting a quotation to supply 80 desks each week. So this is our new weekly number of units to be produced for K Limited. K Limited would require a small design change to the desk, and this would add 5.40 to the direct material cost. And workers on these desks would receive an additional finishing labor bonus of 0.20 per unit. So we can see that this bonus labor as well as the direct material costs are actually variable costs. So we just need to add this amount of 5.40 and 0.20 to our already existing variable cost in order to figure out the variable cost that we need to consider while we take upon the request of K Limited. Let's have a look at the question. We need to calculate the selling price per unit that EMM should quote to K Limited in order to achieve a 20% contribution to sales ratio. Okay, let's first figure out the new variable cost. So this new variable cost will consider the request by K Limited. We just need to add these two amounts, 5.40 and 0.20, to our existing variable cost in order to figure out the new variable cost. And we know that our existing variable cost was of 36.80. So let's just add 5.40 and then 0.20. So this gives our variable cost to be 42.4. Okay. And in the question, we are given the condition that we require the contribution to sales ratio of 20%. So contribution to sales ratio is just the contribution per unit divided by sales price per unit times 100%. So this should be 20%. What we also know is that contribution is just the difference between sales and variable cost. Now, if we take this 100 to this side, we can just write it down as 20 by 100, which is 0.20. We already have the value for our variable cost. We actually use the new variable cost that we figured out to be 42.4. This is equal to 0.20. So this is a very simple equation now. Let's multiply the sales to the other side. So that's going to be sales minus 42.4 equals to 0.20 sales. So if you are to bring the sales to this side now, that's just going to be sales minus 0.20 sales, which will be 0.80 sales. And this will be equal to 42.4. Okay, so the sales price is just going to be 42.4 divided by 0.80, which is 53. So this is the new selling price by considering the condition of 20% contribution to sales ratio. This concludes the fourth part. Let's move to the fifth one. We're again given additional information. It has been decided to quote a price of 48 per unit to K Limited. So previously for HCO, we had the selling price of 44, and this work would involve employing extra finishing labor at weekly salary of 120. Remember, as we said before, weekly salary means that this is a weekly fixed amount no matter the amount of units produced. So this means that this 120 is a fixed cost, and hiring an additional machine at 30 per week. Again, this is a cost relating to per week, which means that this does not affect the amount of units produced, which means that this 30 should also be added to our fixed cost. Then the contract with HCO to produce 220 desks each week would still be continued at a price of 44 per unit, and EMM has decided to set an annual target profit of 17,000. We need to prepare a profit statement for EMM to show the total weekly contribution and total weekly profit if K Limited accepts the quotation. So for this part, we repeat the same process like we did before for part C. So we just need to prepare the profit statement, which we will start with the revenue. Then we will subtract our cost of sales or the variable cost, and this will lead us to our weekly contribution. We then have to subtract the fixed cost in order to get our weekly profit. Alright, we know that we are producing 80 units for K Limited, and the selling price for K Limited is 48. And we are producing 220 units for HCO, and the selling price for HCO is going to be 44. So this gives our total revenue to be 80 times 48 plus 220 times 44, which is 13,520. Now we need to subtract the variable cost. So the variable cost for the 220 units produced for HCO is just going to be our old variable cost of 36.80. Then for the new 80 units produced for K Limited, we figured out the variable cost above. Let's have a look. So the new variable cost was 42.4. Let's substitute it to our profit statement. So that's going to be 42.4. So our new cost of sales is going to be 220 times 36.8 plus 80 times 42.4, which is going to be 11,488. So we need to subtract it from revenue in order to get our weekly contribution. So that's going to be 13,520 minus 11,488, which results in 2,032. Alright, now for the fixed cost, we know that our fixed cost for the first part was 1,350. So we just need to add our additional fixed cost that we were given above. So that's a weekly salary of 120, and then the hiring cost of 30 per week. So let's just add these two amounts. So that's going to be 120 plus 30. So our new fixed cost is just going to be 1,350 plus 120 plus 30, which amounts to 1,500. So we need to subtract this from weekly contribution in order to get the weekly profit. That's just going to be 2,032 minus 1,500, which gives our weekly profit to be 532. So this concludes our fifth part. Let's move to the sixth one. We're given additional information. K Limited have advised EMM that they will only proceed with the order if they are given 5% settlement discount for paying the account within 7 days. We need to calculate the total weekly profit of EMM if EMM agrees to give the settlement discount. Let's just figure out the settlement discount. So we know that the cost for K Limited is going to be 80 times 48. And we are giving 5% settlement discount, so that's just going to be 0.05, which gives our total settlement discount to be 192. And this is a discount given, right? Which means that this discount obviously decreases the weekly profit. So our new weekly profit, we can just start with our previous weekly profit, which we figured out to be 532. So that's 532. And we just need to subtract our settlement discount. So wait, this is discount as well. Okay, so the settlement discount was 192. So this gives our new weekly profit to be 532 minus 192, which is 340. Okay, this concludes the sixth part. Let's move to the seventh one. We need to advise EMM whether or not the terms proposed by K Limited should be accepted, and we need to justify our answer using both financial and non-financial factors. Alright, let's first consider the financial factors. Let's figure out the annual profit before K Limited. So we already figured out the weekly profit before K Limited above in part C, and that was 234. So now in order to figure out the annual profit, we just need to multiply it with the number of weeks, which is 52. So that's 52 times 234. This gives the annual profit before K Limited to be 12,168. Now we need to figure out the annual profit after K Limited. We figured out the weekly profit after K Limited in the above part. So that was 340. In order to figure out the annual profit, we just multiply it with the number of weeks, which is 52. So that's 52 times 340. This gives the annual profit after K Limited to be 17,680. Alright, we can see that there is clearly an increment in the annual profit if we accept the proposal by K Limited. So the annual profit will increase, and the increment amount is just going to be the difference between these two amounts. So that's 17,680 minus 12,168, which gives the difference amount to be 5,512. Now, if you remember correctly, we were also given the annual target profit of 17,000, and we can clearly see that the annual profit is higher than that if we accept the proposal by K Limited. So we can also say that the target profit will be satisfied. So target profit of 17,000 will be met. Alright, then we can also write that it produces a positive contribution. And we also know that the proposal by K Limited was only possible because the company still had spare capacity, right? So we are utilizing the spare capacity by accepting the proposal by K Limited. So let's write it down as well. Utilizes the spare capacity. Then previously we only had one customer, which was HCO, right? But if we accept the proposal by K Limited, we can see that we will be expanding our customer base. So that's customer expansion, which is very good for any business. Next, we know that K Limited presented us with a condition of allowing them 5% settlement discount for weekly payment, right? Or payment within 7 days. So will K Limited abide by the agreed settlement terms, because we have not yet traded with them? So do we trust them or not? That's very questionable. Let's write it down as well. Will K Limited abide by the agreed settlement terms. Okay, so considering all these factors, personally, I would make the decision to accept the terms proposed by K Limited. So let's just write it down clearly. The decision is that EMM should accept the terms proposed by K Limited. Okay, this concludes the 7th part. We can move to the 8th one now. We need to state 2 advantages of cost volume profit analysis to management. So the first advantage is that it obviously aids short-term decision making, right? Let's write it down. Aids short-term decision making. Then second one is that, as the name suggests, it's cost volume profit analysis. So obviously it enables the setting of the most profitable combination of the selling price, cost, and volume. Let's write it down. Enables the setting of the most profitable combination of selling price, cost, and volume. Okay, this concludes the 8th part. Now we can move to the 9th one. We need to state 3 limitations of cost volume profit analysis. Okay, the first one is that cost volume profit analysis is only relevant when dealing with a single product. If you're talking about multiple products, then the cost volume profit analysis cannot be applicable. So only relevant when dealing with a single product. Then it assumes that the selling price remains constant. Assumes that the selling price remains constant. Further, the cost volume profit analysis also assumes that the variable cost per unit remains constant. So assumes that the variable cost per unit remains constant. Alright, this concludes the 9th part as well as this question. If you found this video useful, make sure you like the video and leave a comment below, and make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.